Hello everyone, it's Elliot Gu here with the Free Market Speculator and the Energy Bulletin. And welcome to my Sunday Deep Dive, where we take a look at a key chart, trend, or indicator that caught my eye over the past week, and I explain what it means, or at least what I think it might mean, for markets. So the S&P 500, the NASDAQ 100, and even the Russell 2000 small cap indices, all the major averages, have just experienced a massive rally off the late March lows. Indeed, as I explained in the issue released last Tuesday, we saw the fastest rally from below the 200-day moving average, simple moving average, to fresh all-time highs in at least 35 years of data that I reviewed. So after a massive V-shaped move like that, I'm hearing a lot of investors talk about how the market is overbought and overextended. Hearing a lot of talk about how the major averages have rallied too far, too fast. And that's why I'm releasing this video today, to evaluate that sentiment through the lens of actual history and stock market data. One of the most common overbought, oversold indicators you'll encounter is what's known as the Relative Strength Index, or more commonly just known as RSI. And this was actually invented by a technician by the name of Welles Wilder back in 1978. Now the calculation is pretty simple. It's basically a three-step process, and I'll throw up a quick slide here on your screen to illustrate the calculation in more depth. However, in the interest of brevity, I won't walk you through all the calculation steps at depth in this video, because just about any charting software package or service today will plot the RSI for you. And what's really important isn't how it's calculated, but how to use RSI in practice and what it means. Now, if your broker doesn't offer charts or doesn't offer the RSI indicator for whatever reason, I've found stockcharts.com to be a very good free source on the web for plotting charts of various stocks and indices with this RSI indicator on the chart as well. So here's a chart of the Spider S&P 500, the SPY ETF, with the 14-day RSI plotted underneath it. Now 14 days, that's the most common calculation you'll see for RSI by far. That's actually the one that was initially specified by Welles Wilder, who invented it back in the late 70s. Though I personally also look at the faster 9-day RSI, as I'll show you here in a minute. So in this case, the blue line on your screen, well, that's the Spider S&P 500 ETF. Just the closing price for simplicity. From the end of 2024 through early this past week. The orange line, that's the 14-day RSI indicator. Now the RSI indicator ranges from a level of 0 to 100. And I didn't put the scale on this chart because what really matters is the green and light blue horizontal lines you see there on the chart. As well as, and this is very important, the trend in the RSI line itself. And I'll explain all that here in a minute. Specifically, when RSI is above 70, that's above that green line, that's known as the overbought zone. So you can see what I'm on about. Here's the same chart, except I've drawn in some red arrows to show you periods since late 2024 when the S&P 500 has been overbought. Okay, that happened last summer, summer 2025, and for a few days this month, here in April 2026. Now the light blue line on my chart here, that's the 30 level for RSI. And when it dips below that, we're in the oversold zone. So I've marked some examples of an oversold RSI reading over the same period here on the chart with green arrows this time. So examples of oversold readings include the big sell-off amid the tariff panic a little over a year ago in 2025, April 2025, as well as this year in late March of 2026. Now, here's where things get interesting. You've probably heard people talking about using overbought or oversold crossovers as trading signals, I guess. For example, a rise in RSI to above 70 and then a cross back below 70 could be a sell signal, right? Or conversely, a cross under 30 and then rise back above 30, that would be a buy signal. Now, I hear people say that or some version of that all the time. However, that's largely a myth, and it's certainly not the main way I use this indicator at all. As I said, Wilder introduced RSI back in 1978 in his legendary book, New Concepts in Technical Trading Systems. So I was only 1 year old at the time. So sadly, I wasn't trading stocks or commodities, and Wilder's book was largely pitched at futures and commodities traders, not stock traders, because commodities markets were actually the hot markets at the time. Few actually really cared about equities or stocks back in the late 70s, since the major averages hadn't produced significant returns since the late 60s. However, I did read Wilder's work back around 1991 or 1992. I'm sure I found it in my dad's library. You see, my dad was actually a commodities trader in the late 70s who favored those old school hand-drawn paper charts. Now obviously, traders didn't have terminals and charting software back in the late 70s, and Wilder's work was considered groundbreaking, partly because it explained all the calculations behind some legendary indicators he outlined in his book, like RSI, for traders plotting these charts and indicators by hand. And in his book, Wilder's core concept was not selling overbought markets or buying oversold markets. Wilder saw RSI as a measure of price momentum. And his core concept, the premise, if you will, that was underneath this indicator, was that momentum preceded price. Momentum leads price. Now it turns out he was totally right about that, as I'll show you here in just a moment. Indeed, he stated that in the strongest markets, for stock or commodities in that case, RSI can stay overbought for a long time and remain at or near overbought levels for months. He did call moves above 70 or below 30 as zones of interest, but it was more about watching how price reacted, the actual price reacted around these overbought and oversold levels, rather than simple signals to buy oversold markets or sell overbought markets. So one example is what's known as a divergence or a momentum divergence. And basically that refers to a situation where the pattern in RSI deviates from the pattern in price itself. For example, a stock or index or commodity that makes a series of lower lows in a downtrend, right? While RSI makes a series of higher lows, it's in an uptrend. Now that often, or does indicate waning downside momentum, and it often indicates a potential buying opportunity. However, today I want to show you another way to look at this classic indicator that relates directly to what we're seeing in the broader market this month. I think it also fits really well with what Wilder's original premise when he developed RSI was, as a momentum indicator. It addresses the common sentiment out there that the market today is overbought and that this is somehow bearish. Specifically, consider this. On March 30th, 2026, this year, the S&P 500 was oversold on a 14-day RSI basis, with an RSI of 27.73 at the close that day. Exactly 12 trading days later, on April 16th, RSI closed at 70.45, just inside the overbought zone. Now that's a very rare signal. It's a very rapid swing from oversold to overbought on RSI. Indeed, that's the fastest swing we've seen from oversold to overbought on the 14-day RSI in at least the past 33 years of data that I analyzed. Now here are the next fastest RSI momentum velocity swing examples. So on November 25th, 2016, that was the initial surge for stocks following the 2016 presidential election. Of course, that's the election when Donald Trump won his first term as president. The 14-day RSI on the S&P 500 moved from oversold to overbought in that cycle in 14 trading days. So that's 2 trading days longer than the move this month. Now here's the chart of that episode, using the same color coding I used earlier for simplicity's sake. The S&P 500 was oversold on November 4th, 2016. RSI was at 29.3. Election day was Tuesday, November 8th. And then 14 trading days later, on November 25th, the market hit overbought with an RSI of about 70.9. I've labeled that date on the chart so you can see what I'm talking about. Then, as now, there were a lot of people talking about the overbought and overextended market. However, it was clearly not a bearish omen. Quite the opposite, in fact. As you can see, the period from late November 2016 through 2017, the entirety of 2017, that was actually one of the smoothest, lowest volatility market rallies in history. You have to go back to the early 60s to find a comparable period. There were no significant pullbacks, and the RSI spent a good bit of time in overbought territory, as you can see, as that rally proceeded through 2017. To be specific, the returns in the 6 months following that November 25th signal, the S&P 500 was up 10.3%. And over the 12-month period following the same date, it was up 19.9%. Okay, so now let's turn to one more Hall of Fame RSI momentum swing, and that would be November 20th, 2023, just a few years ago. Here's a chart. Now, I'm sure a lot of you remember this one. I sure do. I was actually speaking at the Orlando Money Show in October 2023. And the big concern at the time, what everybody was talking about, was higher for longer interest rates. This thesis that the Fed was going to need to keep rates higher, even hike rates further to get inflation under control. And the spike in government bond yields was pretty dramatic at the time. Specifically on an intraday basis, the 10-year Treasury yield jumped over 5% around the 19th of October, and the 30-year Treasury yield tops 5.15% around that same time. Now, of course, we didn't know it at the time, but those late October 2023 peaks in yields turned out to be the cycle high for Treasury yields in the current cycle, at least so far. Now, prior to October 2023, you'd have to go all the way back to 2007, before the great financial crisis years, to see 10-year Treasury yields that high. So this catalyzed a big sell-off in the S&P 500, and the 14-day RSI for the S&P closed around 29.2 on October 27th, 2023. Then, 16 trading days later, after a huge rally in the S&P 500, on November 20th, 2023, the RSI closed in overbought territory at about 72.1, a reading of 72.1. Now, I heard talk at that time about how the market had gone too far too fast, and how the normal seasonal Santa Claus rally had been pulled forward and would fizzle. Again, this overbought signal was decidedly not bearish. While there were a couple of pullbacks in the spring and summer of 2024, they were modest bouts of profit taking. And measured from the close on November 20th, 2023, when this momentum velocity signal triggered, the S&P 500 soared 17.52%. That's over just 6 months, and 31.75% over a 12-month, one-year holding period. To put this in context, the average rolling 6-month and 12-month returns for the S&P 500 over the entire period I studied, again, that's since the early 1990s, 33 plus years, it was 5.8% over 6 months and 11.97% over 12 months, so just a little under 12% over a year. So both these RSI momentum velocity examples from late 2016 and late 2023 were extremely bullish for stocks, signaling strong absolute returns and strong returns relative to any historical average. So let's look at this story, the signal, if you will, on a more comprehensive basis, starting with this table. Over the 33-year period I studied, there have been 28 signals using RSI 14, and that includes the current signal. So I divided this data into tertiles, 3 pieces, where there are 10 very fast signals when it took less than 48 days for RSI to move from oversold to overbought. There are 9 fast signals where it took 48 to 70 days, and 9 slow signals where it took longer than 70 days, okay? So 3 different buckets. One of the 10 very fast signals is the current one, which of course we can't evaluate just yet. So that actually leaves 9 signals in each bucket. 9 very fast signals, 9 fast signals, and 9 slow signals. As you can see, the results are pretty interesting. The table presents 20 trading day, 60-day, 90-day, and 120-day returns for the S&P 500 following 14-day RSI shifts based on the speed of the momentum shift measured in trading days. Very fast, fast, and slow. I've also included hit rates. So that's the percent of signals that saw positive returns, and the full sample averages for your reference. Now what's interesting is that very fast signals actually produce superior returns over longer holding periods than fast or slow momentum shifts. Specifically, at 20 days, very fast momentum shifts actually underperform slower momentum shifts in terms of total returns and hit rates. Those such signals do produce better than average returns for the market and higher than average hit rates. So this suggests to me that over the short term, that's out to about 3 or 4 weeks, right? Very fast shifts in momentum are bullish, but there can be some volatility along the way. However, what's really interesting is to look as we move further out in time from these signals, and there's just no contest. Over 60 trading days, the average return from very fast momentum shift signals, like the one we got this month, rockets to 4.1% with an 80% hit rate, compared to 2.83% and a 67% hit rate for slow signals. The 90-day return, it's a bit of a mess really for those slower signal regimes. So if you look at the slow signal row, and you'll see that at 90 days, the average return is under 2.8%, compared to a full sample average over 4%, so underperformance. And the hit rate is barely 50-50, also worse than average. And if we move out to 120 days, that's basically 6 months, these are trading days, the very fast signal generates a near 7% return on average with an 80% hit rate, better than all the other regimes on my table and the full sample average. Bottom line, a rapid move from oversold to overbought isn't a signal to sell, but a sign that the velocity of money has shifted back to the long side, back in favor of the bulls. So let's consider the 9-day RSI indicator quickly based on the same basic table, right? This is a faster momentum indicator than the 14-day, and accordingly, it produced more oversold to overbought swings over the years. And I like indicators that produce more signals because it makes it easier to test. A total of 67 signals, including the current one, to be exact. Since there are more signals, I went ahead and divided the data into quartiles instead of thirds. On this basis, the fastest signals are arguably even more powerful, beating the slower signals and the full sample average over every holding period I examined, from 20 trading days all the way out to 120 trading days. As I said, the current oversold to overbought momentum velocity shift took 12 days for 14-day RSI, and just 9 days for this 9-day RSI, placing it firmly among the fastest of the very fast signals for both regimes. That's bullish, not bearish for stocks. Historically, following a momentum thrust like that, there's elevated probability the market rallies further and produces far better than average gains over the short to intermediate term. I do hope you enjoyed this Sunday deep dive. The data we've looked at today is exactly the sort of deep dive analysis we use to help manage our model portfolio. And the results speak for themselves. So far this year, the model portfolio is up 9.3%, more than doubling the 4.2% return of the S&P 500. If you want to see the specific positions driving that outperformance and get all my alerts, paid tier updates, and model portfolios, I'm offering a 30-day free trial for new readers. And all subscriptions to the Free Market Speculator also include access to our very popular Energy Bulletin service, which we launched late last year. The Energy Bulletin Top 10 Model Portfolio is a carefully curated list of our favorite energy stocks to buy right now and it has quickly become one of the most popular features of the service. Click the link below to join us and see if our approach is right for your portfolio. Thanks again for listening. I'll be back next weekend with a new Sunday Deep Dive video.